This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
This is Matt Russell, and today we are breaking down Agilent. If you aren't familiar with Agilent, it is a $30 billion market cap company at the time of this recording, and they focus on one of the more interesting niches, equipment and instruments sold into laboratories. So you can think of this equipment being sold to the life sciences sector, diagnostics, applied chemical markets, some very unique R&D work. My guest is Mark DeVos, fund manager at Troy Asset Management, and Mark brings us through the story of Agilent. This is something that was born within Hewlett-Packard, spun off a little more than 25 years ago. And Mark helps break down what can be a very complicated concept around things like chromatography and some of the other things that Agilent's involved in. But this is a deeply ingrained industry player with a unique razor and razor blade model and a business that has evolved over time. These episodes tend to be my favorite, and this one lives up to the others. Please enjoy this breakdown of Agilent. All right, Mark, I am excited to have you here to talk Agilent. We were laughing a bit last week before the episode. One of the key things is just going to be establishing what Agilent actually is, what they do. I love these niche industries and the niche businesses that don't get as much airtime or coverage. Let's just start there. Do your best simple overview of what Agilent does as a business.
Agilent is a leading provider of instruments, services, and consumables for labs. Sounds simple. You can picture one of their typical Agilent instruments to be about the size of a small fridge, maybe on a lab bench, something like that. And its core use case is to tell you what molecules are in a sample that you're testing. A real-world use case of this might be you've got a pharmaceutical company producing a drug. Let's say they're making aspirin, and they take one tablet off the production line for every 1,000 tablets that they make or something like that. Those samples could be run through an Agilent piece of equipment, and they would be testing to check they have the right amount of the active ingredient in them, and importantly, that there are no contaminants in them as well. Agilent will sell them the instrument that can analyze that sample and also provide the ongoing service supports and consumables needed to run the instrument.
If I'm thinking about this right, it's mostly biomedical type work that they're operating around and specifically in the labs of those businesses. Is that a fair way to categorize their end market?
Yes. The business itself is actually pretty broad today. They're in 110 countries today, 285,000 labs. So it's pretty broad, split between Americas, Europe, and APAC. In terms of the actual markets, the kind of end customers, pharmaceutical customers are the largest end market for them. So that's about a third of their sales or so. Academia and government, you can imagine universities use the stuff, that's another 10% or so. About 20% of the business is chemicals or advanced materials, which is interesting. So you could think of battery testing for EVs or semiconductor production. And another 20% is actually food and environmental testing. So this would be for contaminants, perhaps in your water supply, something like that.
Is there any way to measure how big of a market this actually is? I'm always curious with these niche industries that revolve around very big end markets as it relates to drugs or anything along those lines. How do you categorize just the overall market size for an Agilent?
Agilent do publish a sort of total addressable market stat, and it's $160 billion, which is unsurprisingly a really big number when you think about all the companies and businesses in the world that need to test samples. Agilent's revenue today is about $6.5 billion, much smaller than that TAM number. In reality, actually, when you dig into those niche end markets, they generally have a number 1 or 2 position in most of their key markets. It's generally a pretty stable competitor set.
If a company publishes a TAM number, it's probably going to be a big one. That's a fair way, but interesting to get that context of 6.5 versus 150, just for perspective. Let's go back to the origin of the business. Where did Agilent come from? What is the origin story? How long has it been around? Anything that's key to its history that you would include?
I think Agilent has a really interesting history. It actually starts way back in 1938. Hewlett-Packard, or HP, started by two electrical engineers, so Bill Hewlett and Dave Packard, working in a garage. Pretty well-known story. And the first product they developed, of course, was actually a testing instrument. It was used to test audio equipment used by Disney in the production of Fantasia, the movie, way back then. Over the years, HP built out their testing and measurement business, both electrical testing, but also over time for molecular analysis. And this included the acquisition of a small business called F&M Scientific in 1965. That business had quickly become the leader in what's called gas chromatography instruments. Their instruments were used for the first full-scale testing for steroids in the 1972 Munich Summer Olympics. The business continued to grow over the years that followed. In 1999, HP focused more on its computer business, and they spun out several businesses, including testing and measurement, into a new business called Agilent. HP kept their computing and imaging business with everything else going into Agilent. It was a bit of a mixture of assets that they inherited, but there was also some real gems in there. It was obviously years or decades of R&D, particularly in chromatography. In the years that followed, the Agilent management team refocused on its molecular testing business. So they sold their medical business to Philips in 2001. They actually had a pretty successful semiconductor component business that they sold in 2005 to KKR in Silver Lake. This would go on to become Avago, which then became Broadcom after they bought it. So it's been tremendously successful on its own. In 2014, that's the most recent significant change. So Agilent spun out their electronic measurement business into a separately listed company called Keysight Technologies. It's still listed today. It's doing well. That's really important. At the time, it was about 40% of sales they were spinning out. And Keysight, whilst it was a great business, was selling equipment predominantly used for testing electronic devices during manufacture. So this was a really cyclical business and didn't really closely align with the rest of what Agilent was doing. The business that remained was entirely focused on analytical equipment for the life sciences, diagnostics, and chemicals market. So much more focused. What the management team was trying to do was have a much more clean, predictable, less volatile business, but still have those long-term growth drivers.
It's very interesting when you find these family trees, Standard Oil being one that broke up, but all essentially in the oil business in various forms. HP being a new one that prior to this episode, I didn't appreciate just how much had been born out of that family. Quite some impressive market caps on those businesses that you referenced. You mentioned the electrical testing versus molecular testing feels very different to me in terms of, yes, they're both testing something at the surface level, but molecular versus electrical feels like it's a very wide gap. Was there a certain cultural DNA or recruiting mechanism that they got people attracted to the overall HP brand that allowed them to do that? This is a bit of a segue, but I am curious how they were able to foster innovation in two relatively different categories, at least to my brain.
I think they inherited a lot of people. So Agilent is still based in Santa Clara. I think they're about 20-minute drive, their current HQ, from the original HP garage where it all started. There's obviously this sort of HP way culture as well, which we obviously own the shares. We've been impressed with the way that they run the business for the long term, the way they look after their people. You kind of get a sense for it, but we experienced that in COVID, where right off the bat, they were first out the doors saying no one in this company is losing their jobs or anything like that. I think that builds up loyalty, and it's not unusual. When we meet managers, they're generally Agilent lifers that started as engineers.
It's interesting where you might have a separation, but there still exists some type of relation to the original family tree and some of the talent that comes along with it. You mentioned when we were talking before a bit of a razor blade approach with their business. How would you categorize what they're doing beyond selling just equipment outright?
In terms of how I think about the business, about a third of it is selling instruments, the largest category of which is chromatography instruments. These are large sort of initial sales. And then 2/3 of the business is selling consumables, servicing, or software, which are mostly related to the instruments they're selling. So it's that roughly 1/3, 2/3 split. I've mentioned chromatography a few times. What this actually is a machine that forces a sample, it could be a liquid or a gas, at pressure through something called a column. You can think of a column as a metal tube that's stuffed with material that slows down the molecules in that sample at different rates. This means that the liquid or gas separates into different molecule groups as it passes through that column. And then on the output of the machine, you've got a sensor that detects the molecules now that they're separated. And depending on the type of sensor, it could also quantify how much of those different molecules are coming out. So it's a powerful tool. Typically, when they're selling one of those instruments, a chromatography instrument, it will cost around $100,000. Obviously, there's a huge range, but let's go with that for now. And it's got a useful life of about 6 to 10 years. Over that useful life, the customer will typically spend another $100,000 on ongoing consumable and servicing spend. That spend is split roughly equally between physical consumables and service costs. So just talking about the consumables for a second, the bulk of that expense is those columns that we just described. They've got a limited period of use, perhaps maybe 2,000 samples, something like that. And you need to replace them as the column's responsible for separating out that material, and it's degraded by high temperature or extreme pH levels, things like that. And that impacts the resolution of the instrument. These are used for pretty critical applications. You basically have to replace it often. It wouldn't be unusual to hear a customer replace it every month or so. Servicing is a bit different. It's more focused on repairs, recalibration, cleaning, or a service called qualification, where they will be validating the machine is operating correctly. So we're saying Agilent is one of only 2 companies that has the ability to service other companies' equipment in the same lab as well. So it's a pretty big benefit if you're dealing with a large customer. And increasingly, Agilent services are sold as part of a broader service contract that's agreed when they sell the new instruments. One of the ways to judge it would be they publish a number that's the percentage of instruments out there that have active service contracts. It's called the attach rate, and it's been steadily increasing over time. So it's gone over the last 5 years from a sort of high 20s number to a low 30s%, and we expect it to continue to grow about a percentage point a year. This is a great business. It sounds boring, but the bulk of Agilent's customers are operating in regulated industries where they need to spend on consumables and servicing if they're using the instrument. The example I gave earlier, quite often the quality control process will be written into the FDA approval for a drug, and they might even mention the exact instruments and consumables being used. Once that happens and it's approved, it's expensive for the customer to move to a different instrument, and also there's some risks attached with that. So it gives a really nice recurring revenue on that consumable service spend.
Is it right to think about the Agilent equipment being used in the assembly line, essentially, once a drug has already passed the approval, rather than in the original testing or drug development stage?
They straddle both. I think probably you're right, though, in that the sales split would skew towards production. They definitely make those cutting-edge instruments which you use for your research and development. There's just a lot more production out there. When you look at the innovations, there's definitely innovations around making the machines higher resolution, more accurate. But actually, a lot of the innovations are focused on throughput, where this is a lab that's testing 10,000 samples a day. And if you can do it with one less instrument, then that's a big saving.
My next natural question was going to be, what governs the decision for a lab to buy another piece of equipment, another Agilent system? Do you see labs with multiple on their assembly line, or is there typically just one associated with each drug? I'm trying to understand whether it's capacity constraints or what drives that.
Typically in a production center, you'd have a lab attached to it, and they would have several instruments as part of that. And generally, they will choose a single primary supplier. They may have a sort of secondary supplier there as well. But just for simplicity, in terms of having spare parts on site, ongoing service and support, it's generally just easier to have one instrument. When they're considering going from that 4th to that 5th machine, they're considering the service they've received. I think most customers would probably highlight service as the primary driver of their decision. It's worth saying the machines are complex. There is a technical capability, so it's not like there's 500 options out there. It's a reasonably small group that you've got to choose from. But Agilent's this one-stop shop where you can get your instrument, you can get your consumables, you can get your servicing, all in one package.
Talk a little bit about the competition. You mentioned there's one other competitor that can actually service third-party machines as well. What does the competition look like? Maybe we can start just in the equipment segment and branch out from there.
Generally, they're competing, I'd say, against 2 main businesses. There are others, but 2 main ones. One being a company called Waters and another called Thermo Fisher Scientific. Waters is a strong competitor in liquid chromatography, but it's more narrowly focused on the pharmaceutical markets. So around 60% of their sales are from pharmaceutical customers. They're also a smaller business, so revenue for Waters is about half that of Agilent, so around $3 billion. Agilent's just above $6 billion. Thermo Fisher's almost the opposite. It's a huge business, $43 billion of revenue, built largely through acquisitions. And if you were to open a Thermo Fisher Scientific catalog, you would see there's a much broader array of products. So they sell everything: lab fridges, test tubes, hot plates, centrifuges, lab shakers, water baths, etc., as well as the chromatography instruments that actually compete with Agilent. So maybe a bit less of a specialist in that sense. What drew us to Agilent was its diversified exposure by end market, but also its focus on niches where it has high market share.
Can you talk a little bit about those niches? If you take a Waters who's entirely focused on pharma, what would be the other categories or niches within those categories that would be highlights for an Agilent?
Gas chromatography is the golden business within Agilent. That's obviously where it came from. So F&M Scientific originally, that HP bought, they were a gas chromatography specialist. Agilent is still by far the market leader in gas chromatography. They're probably 2/3 of the global market for those instruments. They really dominate there. The difference between gas and liquid is predominantly driven by the sample. So gas, unsurprisingly, you're testing a gas. The way you get it to a gas is you heat it or you burn it. If you're a pharmaceutical company and you're testing a complex protein or something, you can't heat it up because you'll destroy it in the process. So therefore, you have to test it as a liquid. So generally, gas chromatography skews what we'll call applied markets. So you can think of that as battery testing, environmental testing for contaminants and pollutants and things like that. They're really uniquely strong, I would say, in applied markets for gas chromatography.
These examples, they're reminding me of refineries from oil and gas, just in the way that they can handle this input and turn it into many byproducts or outputs. There's a lot of differences, but it's interesting how much similarity there is.
One of their customers is testing the outputs of refineries, basically. There are other areas as well where they're pretty strong. So liquid chromatography is the other one. They're probably about 1/3 of the market. Waters probably has about 1/3 of that market as well. And then the balance is smaller players and Thermo sharing the risk. They're also pretty strong in spectroscopy, so that's 40-50% of the market. I'd say that gas chromatography and applied is a post-child market.
I would assume that a lot of the consumables and maintenance has somewhat of a reoccurring or straightforward measurement from year to year. The new equipment sales, you have this 6 to 8 year useful life. Are there major cycles, boom bust oriented, that don't just revolve around customer losses? From an industry perspective, have there been tailwinds or headwinds that have resulted in shocks over time?
In short, yes. Agilent's obviously pretty diversified by end market, which has meant when there's been cycles in some of their smaller markets, they've kind of been able to weather it. One end market's a bit weaker, another market's doing a bit better. Generally, they struggle when they're largest pharmaceutical companies, when that's doing badly, which we've just hopefully seeing the other side of now. They're just coming out of a sort of downturn there. Effectively, what happened was you obviously had the COVID-19 pandemic. There was a lot of investment from pharmaceutical companies into building out lab capacity and spending on R&D, and they bought well above the normal level of instruments. So you saw this boom in instrument sales growth. And then, of course, the CFO turns around and goes, we've got lots of instruments. We don't need to buy any more for a couple of years. You see the other side of that. It looks like we're just returning back towards normal purchase levels now. So hopefully that's behind them. The other notable area is China. So China is about 18% of group sales. It's half of that Asia Pacific region. Obviously, there's been challenges in China. It's a market that's led quite heavily by government grants as well to local companies that then go on and buy Agilent pieces of equipment, basically. We've been through a sort of down cycle there. Again, it looks like that's improving at the moment.
For something like the COVID shock, where you had this major investment, when you think about the useful life of that equipment, and at some point towards the end of the decade, you'll come up on that 6 to 8 years, is the expectation that there would be renewals? Do pharmaceuticals tend to take capacity offline if it's related to something which has a shorter life cycle? How does that work just in terms of the visibility that you might have on the 6 to 8 years and the replacement cycles coming through and showing up in revenue?
I think just talking about pharmaceuticals, there should be growth really in pharmaceutical R&D spend over the long term. We expect to see growth there driven by increasing demand for healthcare, whether that's aging populations. I know the World Health Organization has the population over 60 nearly doubling to 2050. Things like that are just going to drive healthcare spend, in our opinion, in one direction, and that's a tailwind for Agilent. The reality in the short term is that if an instrument's 6 years old, they could, of course, run it until it's 8 years. There's nothing, it doesn't stop working. The parts are still available. They definitely could. What the drives are for that upgrade tend to be these instruments are operating at high temperature with sometimes nasty chemicals inside them. All components in them will eventually wear out. You've got the consumables, which are designed to be replaced, but you can think of all the valves, the heaters, everything else will just start to break more after a long period of time. And lab downtime is problematic for these pharmaceutical companies. They'll want to be getting rid of these instruments before they start to see a fair amount of downtime, which will naturally happen as they become older instruments. They'll just be looking to upgrade. The other thing is there are typically reasonably significant upgrades to the platform every 3 years or so. After 6 years, you're probably 2 years, maybe 8 years, 3 upgrade cycles in. And there should be a meaningful upgrade in terms of either resolution or throughput, which should help justify the upgrade spend effectively.
With the competition, you mentioned that service is a major driver of the decision-making there. When it comes to innovation, has there been a historical trend line for Agilent or maybe a competitor where innovation has really driven market share gains or someone moving up the chain in terms of what they've captured of the market?
I don't think so. We talk to the companies a fair bit and they talk about reasonably stable market shares overall. I think if you do a really good product launch, after a couple of years, you might gain a percentage point of market share. These are very entrenched, stable market shares. Waters actually had a chart in one of their investor days which showed sales of a specific type of column over time. We're talking over decades, and it was basically a flat line. And this was because of that point around it being tied into drug certifications. And once it's tied in, people just use the instruments again and again and again. If it works and they're getting good service, they generally don't change it. So that's why that service component is so key.
You mentioned there's stable market shares. Do those tend to be stable with the same existing customer base? Is there a lack of switching that tends to happen?
It's pretty rare that a customer will build out a whole new lab. They'll generally be upgrading one section of a lab. There's that incumbency bias. We have seen companies talk about some opportunities where you're getting pharmaceutical companies thinking about maybe reshoring labs. That's one of the few examples where you're getting whole new labs being set up. And that's an opportunity where you can kit out a lab. Increasingly, the service part is being folded into the discussion on instruments as well. And this is benefiting those large incumbents. Agilent has 4,000 service technicians that they employ directly. Pretty hard to compete with that. 75% of their technicians hold a degree in chemistry or biochemistry. 25% have a master's or PhD. So these are really skilled, bright people that are out doing 2,500 on-site service calls a day. They're trying to fold that into the discussion around instrument sales more, I'd say.
The point on the risk associated with switching providers might be the most meaningful thing. I'm curious, do you have any data points or measurement for what the cost of this equipment represents to the end customer, just in terms of, is it a large percentage of the overall cost of production or anything else that represents a large or relatively small piece of that?
We think about a production facility that maybe has 5 or so of these sorts of instruments, maybe slightly different types. Over those 5 instruments, let's say over an 8-year period, they're spending $1 million on the instruments and servicing and consumables. It's sort of a rounding error in the scale of a pharmaceutical production facility over 8 years, both from a revenue generated, profit generated, or the other costs in that business. This is one where obviously the cost of a product failure, so if you're failing to spot a contaminant or a problem or something like that, that cost is almost unquantifiable. The damage alone to the brand would be huge.
One of the main things you will hear in these niche markets that represent a very small percentage of the overall product but are mission critical is it's a very good spot to be in if you've captured market share in those industries. I'm curious how that impacts the revenue model broadly. We can break it down if possible. You gave us some sense just in terms of volume trends over time. How do they decide on price? And it might be different, obviously, for new equipment versus service and everything else. But is there a general framework for how you think about pricing as it revolves around the business?
They don't give us sort of full disclosure on price volume, but from our conversations, it seems like they've been reasonably cautious on price. So low single digits in recent years per year kind of number price rises. Certainly not the 10, 15% we've seen in the food companies, for example. I think generally they're aware that often they've got relationships with these businesses that have been going on for 30, 40, 50 years. And they're much more focused around maintaining that business and that strong relationship. And actually, they take a little bit less on price, but maybe the customer takes a service contract or something like that. That more than pays for any lost pricing. Generally, I'd expect low single-digit price growth number with the balance driven by volume.
How has revenue trended, whatever periods you want to pick, whether it's 3, 5, 10? I know you have various things that impact those, but where does this business tend to grow and industry tend to grow at?
I'll pick 9 if that's okay. Not because I'm being selective with my date range. It's the longest that I can go post the Keysight spin. It all gets a bit noisier around that time. Since 2015 or so, sales growth at the business has averaged about 5% organically, about 6% reported. So they've done a little bit of bolt-on M&A. They've had decent margin growth over that period. EPS has grown a fair bit faster, about 13% CAGR over that 9-year period.
We can get into margins a bit. Is there a drastic variance to the extent that they split it between the various segments? Is there a massive variance between equipment sales versus the service and consumables in terms of margin profile?
Yes. Unsurprisingly, consumables and servicing is a fantastic business. I think the instrument sales is definitely more competitive than the servicing. I think consumables is probably the most competitive. So the instrument sale business depends a bit where they're selling to. Selling to life sciences, they're making around a 20% operating margin, but selling to the applied markets I spoke about, it's a little bit higher, sort of 24% or so operating margins. If we think about that consumable and servicing business, that's a 34% margin business. It's grown pretty steadily over time. It's also been amongst the fastest growing divisions.
At 50% of revenue, obviously it's a higher percentage of profit. Where does that go over time, and where did it come from in terms of it being a business that's split 50-50 between those two? What do you expect that trend line to be? And maybe some context in the history would be useful as well.
I think rolling back 10 years, I talked to the very smiley former CEO, he would say they didn't do an amazing job, perhaps, at selling services at the same time they were making instrument sales. So typically it was two different teams. One team would go, yes, we sold an instrument. And then maybe 6 months later, someone from Agilent, they call it cross lab, it's their servicing division, would walk in and try and sell their services, by which point maybe a local technician group, maybe a competitor had already gone in there and signed a deal. One of their core strategic focuses in recent years has been increasing that attach rate that I talked about, the percentage of instruments that have an active service subscription. And they've been pretty successful at that. So they're in the low 30s% of active instruments out there. New instruments sold is obviously a fair bit higher. And if we were to look at some of their peers, Waters, who's been much better for much longer at selling those servicing contracts with instruments, they're in the 50s%. There's definitely a pretty long runway, I think, on that. And then when you think about the economics of that service business, it's a classic density business whereby you're in a city, you've got 5 technicians that operate in that city to take on 5% more business. You don't need an extra person. They're just filling out their calendar. You've got a fixed cost for the office. You've got an admin team there. It really scales quite nicely as you build up density in a local area.
In terms of the conversion, you mentioned earnings growth and that being quite a bit higher than revenue growth driven by that margin expansion. How has the cash flow profile evolved, whether it's cash conversion, anything around free cash flow for the business over time?
The company generates around $1.4 billion or so free cash flow a year. It's about 90% of adjusted net income. It's been pretty stable in recent years, that 90% number. The primary difference has been an increase in CapEx spend in recent years. They're basically building out a facility for a new business segment that they're working on.
I would love to hear more about a new business segment. That always adds something interesting to what feels like a pretty straight and narrow business story thus far.
Perhaps new business segment is actually a little bit harsh. It's actually an old business segment, which is growing rapidly. So they have a notable business that they call NASD, Nucleic Acid Solutions Department, NASD. It produces what are called oligonucleotides, oligos, we can call them. They're basically short strands of lab-made DNA or RNA, and they're used to treat some genetic diseases and, importantly, in some RNA-based vaccines or drugs, including the COVID-19 vaccine. So these oligos are a key part of the production process, and they're used typically to help stabilize the RNA during production, basically. It's basically a chemical that's used during the production of these advanced drugs and vaccines. And Agilent is the clear leader in producing these. It's interesting as it was actually initially a tiny part of Agilent. It was formed in 2006 by merging some technology Agilent already had in-house, which was around knowledge on RNA molecule synthesis, with a business they acquired called SignPro. Again, a tiny company they bought back in 2006. They merged it, kept it running, and then this really took off a few years ago. They continued to develop it over basically 20 years. And then in 2018, they started to see a lot of orders, both for the development and potentially commercialization of some of these drugs. At that point, they had an interesting decision to make. They basically had to either invest $185 million in growing this production facility, or basically not and give away the business either to someone else or try and sell that asset. They decided to invest organically, back their engineers, and so they spent $185 million in 2018, and demand continued to grow. So actually in 2023, they broke ground on a further $725 million expansion of that facility. It's in Frederick, Colorado. So far, demand's been really strong, and they're by far the leader in this sort of niche CDMO sector. It's the same customers, but it's a different product to what they've done in the past.
If chromatography was not complex enough, I'm glad we've introduced something else here. It's very interesting to hear how this has evolved. Am I right to think that the legacy business is in some ways selling the picks and shovels to the gold rush? Here, they're developing an actual molecule. I'm just curious about the demand profile for that molecule and how it might vary versus what you look for in their legacy business, or what else you would point to in terms of the differences, because you tapped into it there, and I'm just curious if you could expand on that a bit more.
They're not generally tied to a single pharmaceutical company. They work with basically all of the main manufacturers of these types of drugs. There is definitely a more customization for each specific project, so they generally partner with them quite early during the development phase. Agilent probably won't be making very much money on it while they develop these custom sort of oligos to support the project. But the payback is if they make it to commercialization, and some of them are now moving to commercialization, that the volume really ramps, and that stays with Agilent. There's no other company that has equal capacity or larger capacity than Agilent for producing these specialist oligos. Like most things, it's probably easy to make in really small quantities, but if you want to make production grade stuff where you can make 100,000 vaccines, then really it's only Agilent you can work with who have that facility. There are definitely differences, I think you're right, but it's similar in that it's not tied to a single all-in one drug or nothing.
Is it tied to the mRNA more broadly, that theme within pharma broadly?
Correct. The step back of RNA-based drugs is unhelpful, and things like changing in the funding environment and things like that, you definitely see that in some of their results where companies focus less on R&D 1 year and more on commercialization to respond to funding changes, basically.
And you mentioned it's gone from small to, it's not huge, but it's a much bigger portion of the business now. What does it represent versus what it was before?
Their core NASD internally developed is a little over $300 million now of revenue. They've also acquired a business for about $1 billion called BioVectra, which is in a similar space. It does slightly different things, but very similar. So altogether, they're about $470 million of revenue, so about 7% of sales or so for Agilent.
Impressive to come from something so small, especially when the rest of the business is growing alongside you. When you think about that as a shareholder, you mentioned a bit about the margin profile not being great in the early stages. So you're investing with this long cycle return. I'm just curious to get into your head about how that all felt maybe years back versus where we are today, because it is a bit different with inside the business. And they've gone from, if we go all the way back to the HP days, that being a conglomerate in many things, to much more pure play. How do you frame that type of somewhat strategic adaptation to include this with some of those things in mind?
Way back at the start of the conversation in Agilent's history, I went through an example where they gave away or sold for a tiny price a business that went on to be a core part of Broadcom today. Obviously, it would have been nice if they kept hold of that one. Agilent engineers have clearly developed something that's unique and seeing demand from customers. It's a healthy sign that the company is willing to back them with the capital that they need. They run a pretty cautious balance sheet. They've got 1x net debt EBITDA. If it's a choice between basically giving away the opportunity to someone else who's going to spend that money backing your own engineers, we were pretty glad to see they had a culture, firstly, where they could reach the right people to make that kind of decision, and then also where they decided to back their team and build out that facilities. We viewed it as a positive.
When it comes to other capital allocation decisions, you have CapEx there, reinvesting in the business and some of the opportunities. You tapped into some bolt-on M&A historically and some bigger acquisitions. How core to the overall Agilent thesis is M&A and the willingness to continue to look for bolt-ons, other deals that fit the general thesis of what they're doing?
I think they've got a decent long track record of doing small bolt-ons. We think that's a pretty good thing. I wouldn't say it's a significant driver of growth, at least in the short term. They've generally used them for one of two purposes. One would be to fill in a small technology gap. So, for example, they recently acquired a software business that specializes in lab productivity software. So now you can buy your Agilent instrument consumable service and plug it into this Agilent piece of software that will track usage and reorder consumables and call service technicians automatically if you're a machine break. All of that kind of stuff seems pretty logical to acquire a small business that's doing that. So we like that. The other would be to add adjacent products where they're selling to the same customers. So that would be BioVectra recently, where they've got this NASD business that was organic. BioVectra had some additional capabilities, particularly around filling and packaging some of the products that benefited that NASD business. And that, to us, felt reasonably sensible. Of course, there's always an element of risk. And as the deals get larger, the risk goes up. So we're keen there's a sort of upper level on acquisition prices. But so far, they seem to be being sensible. And I wouldn't say it's core to the strategy.
There's a history of it. It's not core to the thesis from year to year, but it can be a nice tack on when executed well. When thinking about valuation for Agilent or this type of business in general, how would you say investors generally frame valuation for this type of business, whether there's a specific methodology? And feel free to group yourself in there with any type of methodology that you think is relevant.
We tend to focus on either free cash flow yields or price to earnings multiples. I think we find them the right mix between simple enough to ensure usability, but also comprehensive enough to actually be useful. Agilent, for example, was trading above 4% free cash flow yield in recent months, which is close to the highs it's been over the last 10 years, basically since the Keysight spin, which we view as pretty reasonable for a business that we think should be growing earnings high single digit. That equates to a just sub 20 times price to earnings multiple. Again, looked reasonable for a business like Agilent, where cash conversion is pretty stable. The two are largely interchangeable. Generally trying not to overcomplicate it. If we really like the business and we're confident about the long-term growth, then as long as the valuation looks reasonable, we're likely to invest.
I admire it. I will not poke any holes in it. Oftentimes, I love a simple PE multiple inverted into a cash flow yield when the earnings conversion is fairly smooth into free cash flow. So bonus points for me on that. Simplicity is often a good thing. You outlined it fairly simply, even in that response, where there's visibility into high single-digit earnings growth. You do have this cash flow conversion. Would you say there's any tailwinds that could result in more material outperformance? I rarely have to mention this in an episode because usually we get a very bullish presentation of the different things. I think this has been very balanced and fair in terms of presenting the business and the outlook. Is there anything that you think is missing or not mentioned as a potential upside lever or catalyst?
I wouldn't underestimate the need for telling what is in a sample and the unusual use cases that pop up for that. The most recent example of that I'd point to is PFAS testing, or forever chemicals, as they're often referred to in the press. There's a huge amount of regulation that's appeared in the last 2-3 years around testing food and the environment and chemicals as well for the presence of these PFAS. They're long-lasting chemicals that's used in everything from sort of non-stick pans to firefighting chemicals. The problem is they find their way into food and water and humans and children as well. And they've been shown to be harmful to consumers in several studies. There's a lot of regulation coming in. This is already a $400 million market, growing 20% per year, and Agilent is the clear leader in this market. So this is a sort of market that popped up overnight where we need to test this sample. Agilent's the clear leader in applied market testing, and it's growing like an absolute weed. So there's definitely upside from these testing markets seeming to appear out of thin air.
Interesting example that paints the picture quite well. On the opposite side, when you think about the risks, you referenced some of the cycle exposure that they might have. Is there anything else, any customer concentration risk or anything else, whether it be from overseas, cheaper products, things along those lines that stand out to you?
The primary risk to the business we spoke about earlier is that cyclicality based on those big end markets. So if pharma isn't spending, that's not a great environment for them. They're not too reliant on US government funding or anything like that. So academia and government is only just under 10% of sales. And actually the NIH-related funding, which is the one that's particularly under pressure, that's only about 1% of their sales. So it's not a huge part. China's the only other part that's hard to forecast. I think we can be confident about the need for testing there in the long term. In the short term, of course, it can be hard to predict. They're the main ones I'd point to.
This question will come a bit out of order, but the M&A thesis that I described within the business, I'm curious if this is ever a target of M&A in terms of them being acquired, Agilent being acquired. Does that come up? Because it does have certain characteristics which would fit what acquirers would look for. And I just wonder if that's ever out there in the market or in the headlines.
I haven't seen that in the market, if I'm honest. It's hard for one of their direct competitors. Thermo Fisher would, I'm sure, love to buy them. Very acquisitive company. It's much larger. Probably could if it really wanted to. I think the challenge would be you'd attract competition scrutiny. I struggle to see that one happening. Otherwise, we certainly hope they remain a sort of independent business.
Yes, don't get in the way of compounding. Well, this has been fascinating, and I think you simplified some pretty complex topics, so I appreciate that. I can say that personally. The way that we close out these conversations are with the lessons that you could potentially take away and apply elsewhere as an investor. What would stand out from doing your research and your experience with Agilent that might be a takeaway for other investment work?
There's two that came to mind. The first one would be not to underestimate the quality of what sounds like a boring business. If I was to tell you at the pub about a business that services lab instruments, you might be forgiven for telling me to move on. Actually, this is a fantastic business, 33% operating margins, growing high single digits with a really good long growth runway as they grow that attach rate, not to be underestimated. The other one would be that actually often it's better to be in the businesses that are supplying tools. In this case, the life science tools companies have outperformed the pharmaceutical sector hands down, and Agilent is a testament to that.
Picks and shovels. It's been working for almost 200 years now. Well, Mark, this has been an excellent conversation. It's been a pleasure. Thank you so much for joining us.
Thank you.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JoinColossus.com.